Many who work for themselves as contractors or freelancers are often operating as sole traders. For those starting out on their own, for financial reasons, this is the simplest approach due to lower tax and accounting requirements, especially with regards to tax returns. Once you're up and running and your earnings start to increase, many sole traders start to weigh up the benefits of creating a limited company instead. The move to a limited company and paying yourself as a director from the position of a sole trader provides some significant savings for tax purposes. By forming a limited company, sole traders can also transfer liability from themselves to a separate entity. The question many sole traders ask: when does setting up a limited company provide savings for tax purposes? Depending on which accountant you ask, sole traders should consider the move once their income is between £20,000 and £30,000 a year. Forming a limited company and paying yourself as a director will require the services of an accountant, which comes at a cost. Those with an income below this amount are likely to benefit from remaining as a sole trader, as the costs involved in forming the company and ongoing reporting will outstrip the tax savings. One major benefit for directors of companies is their ability to pay themselves from a limited business in a way that reduces their personal income tax and national insurance liability. Sole traders are able to deduct allowable expenses from their income. This profit, after their tax-free personal allowance, is then taxed at standard income tax rates of 20, 40 or 45%, depending on how much you earn. They also need to pay national insurance rates starting at 6% and reducing to 2% over certain thresholds. On the other hand, directors of limited companies can choose how they are paid. Many will pay themselves as an employee of their own business up to their tax-free personal allowance. The limited business will need to pay negligible national insurance contributions for this amount, with no income tax or national insurance contributions to be paid by the director. This payment also entitles the director to benefits received by those paying national insurance on income above this amount, including the state pension. Beyond this, directors can elect to pay themselves dividends from their business. The first £500 is paid free of tax, as this falls within the dividend allowance, with dividends over this amount taxed at a lowly 8.75% within the basic rate band. Dividends paid within the higher rate tax band are taxed at the higher rate of 33.75%. This is still below the 40% higher rate tax that will be paid on profits by the sole trader. There's still a saving on dividends at the additional rate, as they are taxed at 39.35% rather than 45% for sole traders' profits. Let's take a look at Harriet, a sole trader with profits after allowable expenses of £40,000 for the year. After the use of her tax-free personal allowance, she owes £5,499 in income tax and £248 in national insurance contributions. Of her £40,000, Harriet takes home £31,520. Now, let's consider Jessica, who formed a business and pays herself as a director. She too is able to pay herself £40,000 from her limited business for the year. She sets herself up on her own company payroll to pay her tax-free personal allowance as income from the company account. She personally is not liable to national insurance contributions on this income, although her employer, her company, will be. The remaining amount she elects to receive as dividends. As this amount is within her basic rate band, she will only pay dividend tax of 8.75%. In addition to this, the first £500 of dividends, the dividend allowance, are received tax-free. She therefore pays tax of £2,356 on these dividends. As a director, Jessica takes home £37,644, £6,123 more than Harriet. In this simple example, it's clear that, as a director, Jessica is better off. What we've not addressed is the additional costs incurred by Jessica as a business owner. Although she's saving more on tax as an individual, her company still has to pay corporation tax on profits, which includes her dividends. She also has to juggle all the extra admin and costs that go along with managing her business. If you'd like to explore the pros and cons of being a sole trader, the Xenia Learning page provides further reading, along with a transcript of this video for future reference. If there are any areas of finance you'd like explained in further videos, don't hesitate to leave us a comment or get in touch with us directly. We're happy to help on an individual basis. Remember that if you're looking to set yourself up as a director of your own business, it's always wise to consult a professional before doing so. You may save yourself some time and money staying put. Until next time, plan smart and prosper.